Hello, hello, hello. This is Toria Howard, the real estate educator, here to educate you back once again to give you all that you need to make informed decisions about your buying process. And also, if you're a homeowner or you're an investor, but today we're catering to first-time home buyers. So, like I said, I am a licensed real estate agent here in the beautiful city of Detroit and the surrounding areas. I am not only a real estate agent, but I'm an educator by day. And I choose to teach financial literacy because I know what it feels like when you don't have it. So that's why I'm passionate about it. I tell my story all the time. I was a homeowner. I lost my home in a short sale because I did not have a financial plan. And I ended up costing myself like 150 to $200,000 when it was all said and done. And I don't want other people to make learn that same lesson. So let's talk about it. And please like, share, subscribe, comment. Let me know if you have any questions. Reach out to me in the comments and I will definitely get back to you. And let's get started. So, how to know if you're financially ready to buy in 2026 is what we're talking about today. Because you have to be financially ready, not only emotionally, but you also have to be financially ready. And a lot of times our finances and our emotions that mixes together. So we need to make sure that you're financially ready. So pre-approval does not mean financially ready. You can be pre-approved for $400,000 and still not be positioned. You have to make sure that you have all of the things that you need to do in order so that you can make the best informed decision and make sure that you are buying smart. So today, I want to talk about what readiness really looks like because many buyers confuse approval with preparation. And if you're planning to buy in 2026, this video will confirm that you're ready or show you what you need to fix. So let's get started with that part. Please like, subscribe, share if you want more of these type of videos. I do this every single week. So let's start by saying you were pre-approved for $375,000 and the lender says your payment is $2,600, but your current rent is $1,650. That's a $950 jump that you could not be possibly prepared for because a lot of times when you get that pre-approval amount, you don't qualify the rest of your lifestyle that's wrapped around it. Utilities, your 1% maintenance fund, and your home warranty have to be a part of that. So if that's not a part of that, then you're missing some key components when you're talking about paying. So if that 2,600 don't include those other three things, emergency 1% emergency maintenance fund, utilities, and uh your home warranty, then that's not affordable for you. If that 2,600 is going to make you not live the lifestyle that you want to live, as far as doing the things that you're used to doing things for your children, being able to put food on the table, then that's not the number for you. So you need to make sure that you're understanding what your number is. So have you ever consistently lived on that difference? Is the question. $950 is a lot of money. You know what I mean? For some, but not for some. But for many, it is. And you have to make sure that you have that gap in there and understanding where that money is about to be allocated to. So sometimes you have to make sure that when you're spending less than what you are qualified for the mortgage, where is that extra money going and how can it be reallocated? That's what needs to happen. So most people haven't thought about that. So approval equals what the bank says you can afford. Readiness equals what your life can comfortably sustain. Because you want to sustain, you don't want to maintain. You don't want to be scrambling. You don't want anything to hinder you from being able to do other things. Because you have other bills you have to pay. Your children are a bill. You want to, have some luxuries in life as well. So you don't want that to hinder you. So approval gets keys, affordability keeps peace. And you want your peace intact, right? So make sure you're liking, subscribing, and commenting. I do this every week. I break these things down every week. So definitely do that. So here are 5 signs you're financially ready. So you know your comfortable payment. Now you can go on Zillow and Realtor.com, and they have calculators in there, and they'll show you if you put the certain percentages down of, the different down payment types, because they default at 20%. You don't have to have 20% to buy a home, but they default at 20%. You can have as low as 1%. But that's probably coupled with down payment assistance. So, you'll still put it at the average of 3.5% when you're using mortgage calculators, because Realtor, I know for sure, they will give you also the estimated taxes and also the other things that goes along with it. So you want to know what your comfortable payment is, not Zillow, not the lender, you. Okay. If your income fluctuates, bonuses, commissions, are you budgeting off your base salary? Because a lot of us get bonuses and things at work, but that's not a constant thing that's going to happen. And hopefully that you're taking that bonus and you're putting in your emergency maintenance fund, some of it, and you're investing, hopefully, and sell that money and make more money. But that's besides the point. I just got into a little bit more of a financial literacy thing, but you want to make sure that you're doing it off of your base salary. Smart buyers don't stretch to their ceiling. You don't want to stretch all the way to the top, because you're going to be very uncomfortable. You've practiced your payment is the second thing. And when I say practice your payment, if your future mortgage is $2,400 and your rent is $1,700, have you been setting aside the extra $700 monthly? But if you have not, is it a way that you still have that $700 somewhere that is going where it can be reallocated and you still be able to live your other life, you still live your lifestyle? So if not, you're guessing. If yes, you're positioning. You want to make sure that whatever that gap is, that you have that extra money that you're going to be paying is affordable, that you're not taking away from anything that's important to you and things that you want to do with your life and your children, your family. That $700 might be going to, vacations or whatever the case may be. So you want to make sure that you are looking at your full budget on your base salary, looking at the things that maybe you can stop doing in order for you to afford, if that's what you want to afford. Because some people when you get to a certain price point, you see homes that you fall in love with quickly, depending on where you are, of course, but you fall in love quickly and you want that house. You will go to the limits, but you don't want to go to the limits. You want to make sure that you're comfortable with the payment. So the third thing is you have a buffer. You want to be able to have a buffer, not just closing costs. You want a buffer for HVAC repair, property tax increase, insurance changes, job transitions. So like in Detroit, because we are transitioning so much and the city is rebuilding quickly, especially when the Joe Louis Greenway is completed, if you're buying in that area, your tax is going to go up because your home appreciation is going up. You have neighborhoods right now that are going up 7 to 10%, 7 to 15% in some areas appreciation year on year, when the national average is only 1 to 5%. So you have to be able to understand that your property tax is going to go from here to real quick, because especially in redeveloping areas, you need to watch out for that and know what those numbers are. That's just, for example, insurances do change as well. So you always, every year, you want to shop around for the best rate. And if you did have a claim, most likely your insurance is going to go up. Even if you've been paying, it doesn't matter that it goes up. So you want to make sure that you have the HVAC repair falls under your maintenance budget. If you have that 1% maintenance budget, so for instance, you're supposed to have 1% of your home's value or your home's purchase price. When you first start to purchase a home, is your purchase price. But once you get in there, it's your home value, because it's going to continue to go up if you bought smart and not go down. So, so for instance, if you bought a home that's $200,000, that means every year you should have at least $2,000 saved. Now you can do more or whatever, or you can do less, but minimum you should do is 1% and 1%. And you want to do that with your, with your home value increases. So once your home value increases, you're looking at that every single year. You want to add to that and be comfortable with adding to that. So you put that in a high yield and savings account as well. So make sure that you're understanding that it's not just going in a regular savings account, it's going in a high yield savings account. Um, and then if you're, sometimes things happen with your job. So just make sure you're buffering for that. But let me give you this example. So a water heater breaks week 3. What's your move? Home warranty. Hopefully you have your home warranty in place. But you also have that 1% maintenance fund because sometimes they'll find a way not to pay, unfortunately. So you need to make sure that you have that 1% maintenance fund. So number 4 is your debt is controlled. So credit cards are under 30%. No new cars, no new car notes, no furniture financing. You don't want to do any of that until after you buy your home because you don't want your debt to income ratio to go up because the more debt you have, the less you qualify for it. So unless that debt is accumulating income and it's an asset, that's something different. That's a different story for a different day. But you don't want in this time period of in which you are getting pre-approved and going through the buying process and at the closing table, wait a week to buy the new car, buy the new home. You just never know. I mean, not buy the new home, buy the furniture, have the furniture on, you know what you want. Go get that after the fact. Don't do it beforehand because your debt to income ratio is going to increase your DTI. So I've seen buyers lose over $300 worth of new credit activity because they were not smart with debt control. So you got to have that debt control. And the fifth thing is you understand post-closing costs. Okay. You have utilities, you have maintenance, you have seasonal costs, you have an HOA if you move into a subdivision that has an HOA. So buying is math plus lifestyle. So utilities, you can call the energy companies where you are and you can say, what is the average, so you'll know. And I will always go up a little higher. Your maintenance fund is that 1% maintenance fund you should have every single year. So if you, like I said, $300,000 house, 3,000 saved a year, break that down, um, you know, per month. So let's do the math, right? I should know this, but I'm an English teacher. So that's $250. If you three is $3,000 a year is $250 a month. So you need to make sure you're able to do that because you want the lifestyle too. You don't want to be house poor. So some things that buyers get tripped up on is emotional trap. So why buyers rush? So buyers rush because of social pressure, everyone else is buying, fear of rates going up, comparison. You're comparing yourself to other people or whatever is in your circle, however that looks like for you. But you need to make sure that you are thinking strategically and not in your emotions. Get out your feelings, baby, and think strategically and get you a plan. So emotions rushes, strategy positions, and you want to be in position. And the only way you can be in position is doing those things that I just told you, right? So don't fall into, the things that I told you not to do. All right. You want to make sure that you are ready by using those 5 signs, right? You know your comfortable payment. You've practiced your payment. You can have a buffer. You are practicing debt control, that which is self-control, and then you understand the post-closing costs. So, and then don't just get caught up and just go out and just do anything and everything and want to hurry up and buy quick. Make sure you're buying right, you're buying smart, and you're buying in a great neighborhood is going to appreciate. So if you're serious about 2026, this quarter matters. We at the end of quarter 1. So comment ready. comment ready, and I will make sure that I get back to you. And let's start your Pathway to Keys journey. So subscribe, book your Pathway to Keys consultation. That will be in the description section of this video, that you can go ahead and have a meeting with me, and that'll be, complimentary to you, so you can see where you need to start. So this program exists for buyers who want clarity before commitment. So have an amazing day. Thank you for tuning in. Like, comment, share, subscribe, and I will see you next time with Tori, the RE educator.